Imagine waking up tomorrow morning, and while you were sleeping, your money was still working. You weren't answering emails. You weren't clocking in. You weren't making sales calls. You were asleep. But somewhere in the background, assets you own were potentially generating income or increasing in value. This is one of the biggest differences between simply earning money and building wealth. When you work for a paycheck, you trade your time for money. But when you own productive assets, your money can potentially work alongside you. And here's the important part. You don't need to be a billionaire to start. Today, we're looking at 7 assets that can potentially generate income or build wealth while you're not actively working. Some are accessible with relatively small amounts of money. Others require significant capital. And none of them are magic. Every investment comes with risk. But understanding how these assets work can completely change the way you think about money. Let's begin. The first asset is one of the simplest ways people can participate in the growth of the stock market. Broad market index funds. Instead of trying to guess which individual company will become the next giant, an index fund can give you exposure to many companies through a single investment. Think about what that means. Instead of depending entirely on one company, you own tiny pieces of many companies. Some businesses will struggle. Some will disappear. Others may grow dramatically. And because you're invested across many companies, you're not depending on one winner. One of the biggest advantages is convenience. You don't need to sit at your computer every morning watching stock prices. You can contribute regularly and allow your investments to potentially grow over long periods. And if the fund pays dividends, those distributions can potentially be reinvested. But remember, the stock market can fall. Index funds aren't guaranteed to make money, and past performance doesn't guarantee future results. The idea isn't to get rich overnight. It's to put capital into productive businesses and give it time. The second asset is one of the oldest wealth-building assets in the world. Real estate. When people think about real estate, they often think about houses. But real estate can include apartments, commercial properties, warehouses, office buildings, and other income-producing properties. The basic idea is simple. An investor owns a property. The property generates rental income. That income can potentially cover operating expenses and financing costs. And if the property increases in value over time, the owner may also benefit from appreciation. There's another interesting feature. With certain types of financing, an investor may be able to control a larger property with less than the full purchase price in cash. That's leverage, but leverage cuts both ways. If the property performs well, it can potentially amplify returns. If the property performs badly, losses can also be amplified. And real estate isn't truly hands-off. Properties require maintenance. Tenants can leave. Taxes and insurance cost money. Vacancies can happen. Repairs can be expensive. So the real lesson isn't that you can buy a property and forget about it. It's that productive real estate can potentially generate income even when you're not personally working every hour to earn it. But what if you like the idea of real estate without wanting to become a landlord? That's where the third asset comes in. Real estate investment trusts, or REITs. REITs allow investors to gain exposure to certain types of real estate without directly purchasing an entire building. Some REITs own apartments. Others focus on warehouses. Some specialize in data centers, healthcare properties, shopping centers, or other real estate sectors. Investors can potentially receive distributions from the income generated by the underlying properties. And because publicly traded REITs can be bought and sold through brokerage accounts, they can be much more accessible than purchasing a physical building. But there's a catch. REIT prices can move up and down like other publicly traded investments. Interest rates, property values, economic conditions, and business performance can all affect returns. So don't think of REITs as guaranteed passive income. Think of them as another way to gain exposure to real estate. The fourth asset is considerably less exciting, but that's exactly why many investors pay attention to it. Bonds. When you buy a bond, you're essentially lending money to a government, municipality, or company under specified terms. In return, the issuer generally agrees to pay interest and return principal according to those terms, assuming they meet their obligations. That can create a predictable stream of interest payments. For example, imagine you own bonds that pay interest periodically. You don't have to build a product. You don't have to manage employees. You don't have to sell anything. The bond simply follows its payment schedule. But bonds aren't risk-free. Different bonds have different levels of credit risk. Bond prices can also move when interest rates change, and inflation can reduce the purchasing power of future payments. So bonds aren't about getting rich quickly. For many investors, they're about income, diversification, and preserving capital within an overall portfolio. The fifth asset is dividend-paying stocks. Some publicly traded companies distribute part of their profits to shareholders. If you own shares of a company that pays dividends, you may receive cash distributions based on the company's dividend policy. Imagine owning shares in hundreds of businesses. You don't manage those businesses. Employees do, executives do. Customers buy their products. And if the companies choose to distribute profits, shareholders can receive a portion. That's a powerful concept. You're participating in the ownership of businesses without personally running them. But there's an important distinction. A dividend is not free money. A company can reduce, suspend, or eliminate its dividend. The stock price can also fall, and a very high dividend yield isn't automatically a good thing. Sometimes a high yield can be a warning that investors believe the company's future earnings are under pressure. So don't chase the biggest number. Focus on understanding the underlying business and the risks. Now let's move away from traditional investments. The sixth asset is something almost anyone with useful knowledge can potentially create: digital products. Think about an online course, an ebook, a template, a design pack, a spreadsheet, a software tool, or educational resources. Here's what makes digital products interesting. You can create the product once and potentially sell it many times. Imagine spending several weeks creating a useful financial spreadsheet. Once it's finished, you could potentially sell copies without rebuilding the spreadsheet for every customer. That doesn't mean the income is automatic. You still need marketing. You need customer support. You need updates. And competition can be intense. But compared with a traditional service business, a digital product can have a much different economic model. Instead of repeatedly selling your time, you're creating an asset that can potentially be sold repeatedly. That's why digital products can be an interesting form of intellectual property. And that brings us to the seventh asset: content and intellectual property. A YouTube video, a book, a website, a photography library, music rights, software, educational content. These can become assets because they can potentially continue generating attention or revenue after the initial work is finished. Think about a video you upload today. You might spend hours researching it, writing the script, recording the narration, editing the visuals, and publishing it. But once it's online, it doesn't necessarily stop working. Someone could discover it tomorrow, or next month, or years later. If the content remains useful and attracts viewers, it may continue generating opportunities or revenue. That's fundamentally different from a job where you generally have to keep working to keep earning your salary. But again, nothing is guaranteed. Most content doesn't become hugely successful. Algorithms change, audience interests change, advertising revenue changes, and maintaining a successful content business requires ongoing work. Still, the underlying principle is fascinating. Create something once, then allow it to potentially create value repeatedly. Now let's step back. What do index funds, real estate, REITs, bonds, dividend stocks, digital products, and content have in common? Ownership. That's the real idea behind building wealth. Instead of only asking, how can I make more money? Start asking, what can I own that can potentially make money or increase in value? Because there are only so many hours in a day. You can work more hours, but eventually your time becomes the limitation. Assets can change that equation. You can own a piece of a company, you can own property, you can own intellectual property, you can own digital products, and over time, those assets may potentially produce income or appreciate. That's why wealthy people tend to focus heavily on ownership. But there's one thing you should never forget. An asset isn't automatically a good investment. A property can lose money, a stock can crash, a bond issuer can default, a digital product can fail, a YouTube channel can never find an audience, And something advertised as passive income can require enormous amounts of work behind the scenes. The goal isn't to find something that makes money while you sleep with zero effort. The real goal is to build systems and assets that can eventually separate some of your income from your direct labor. That's a much more realistic definition of financial freedom. So let's recap. Number 1. Broad market index funds. Number 2. Real estate. Number 3. REITs. Number 4. Bonds. Number 5. Dividend-paying stocks. Number 6. Digital products. Number 7. Content and intellectual property. You don't need to own all 7. You don't even need to start with a lot of money. The important question is, what can you start building today that could still have value years from now? Because the wealthy don't only work for money. They use money to acquire assets. And eventually, those assets can start working alongside them. While they're working, while they're traveling, while they're spending time with family, and yes, while they're sleeping. This is capital theory. If you want to understand how money, assets, businesses, and wealth actually work, subscribe. Because the goal isn't just to earn money, it's to build something that can outlive your effort.